Howdy, Jacob here. Today we're looking at Chewy in the specialty retail industry, 11 billion market cap on 9.9 billion enterprise value, founded in 2010. Wow, all right. They engage in pure play e-commerce business, provide pet food, treats, pet supplies, etc. Their growth has been very impressive, but revenue growth is declining quite a bit. We see it was as large as 134% year over year in 2018 and is dampened to about 10% in the most recent year. Still very solid growth. Gross margin of high 20s, not bad. Still trying to figure out how to make some operating margin as it's been very, very low. Let's see if it's R&D or if it's... All right, so it's just cost of goods sold and sales, general and admin costing a lot. But as long as their revenue growth grows faster than expenses, they should get to a good point where they can start making some money here. 1.1 billion in cash-like products with no short-term or long-term debt. 528 million of their capital leases. Not bad. Very safe balance sheet. Free cash flow is much higher, and it is due to stock-based compensation being very heavy. But even still, their use of cash is really just reinvesting and I guess making a little bit of acquisitions. They haven't been making money on the free cash flow side very long, so we don't have a whole lot of history to go off of capital allocation, but we are going to have to make some assumptions, and that means we're probably going to have to increase our margin of safety. So revenue growth, I think that, there are some competitors here, but I know so many people that have heard of Chewy. I think that 8% seems pretty reasonable to me with how much they're reinvesting back in themselves. For margins, I really don't know. Maybe 2 and 3%. And 1% share issuance would be about 110 million. And it looks like they've issued a little bit more than that. So let's say 2%. Terminal PE on 8% growth. Maybe 17, slightly above market average here. And maybe I'm really low on these margins because they're still reinvesting everything. So maybe their long-term margins maybe mid to upper single digits. That could maybe inflate this, but based on what I'm seeing right now, I don't feel comfortable increasing it much higher than that. So for me right now, saying the company needs to fall 78% before you get the return we're looking for here. So I'm just going to be reviewing other companies in the meantime. And I hope you enjoy the video and have a great rest of your day. Thank you.